This ETF Minute is sponsored by CI Global Asset Management. This video is for general informational purposes only and not personalized investment advice. This is the ETF Minute on In the Money with Amber Kanwar. Today we're talking about the CI Canadian REIT ETF. The ticker is RIT. And to do that, we've got Lee Goldman with us. He is a Senior Vice President and Portfolio Manager at CI Global Asset Management. Lee, thanks so much for joining me.
Oh, thanks, Amber, for having me. I'm very excited to be here.
I think Canadians love REITs, they love dividends, but let's start with the ABCs and just talk about the role that REITs are supposed to play in your portfolio.
I think a lot of investors do look to REITs for income. So if you look at the subsectors of the Canadian market, the GIC sectors, the 13 of them, the REITs are actually about second in terms of highest dividend yield. So telcos would be number one, not quite as high as it used to be because of the BCE cut. But REITs at about a 5.5% yield are right there. So for investors looking for income and actually tax advantaged income, because REITs are awfully more tax efficient than certainly regular ordinary income or than interest income, the REITs are a great spot to look.
Let's talk about how they're trading right
Sure.
now, because we've had a number of guests who come on the show and say it's cheaper to actually buy real estate in the stock market than it were to be if you were doing, a real land transfer. And that's just because these REITs are not getting full credit for the net asset value in their stocks. Like, how unusual is that, or how exacerbated is that at this moment?
Right. So that is one of the key metrics that we look at. Where are REITs trading in relation to their underlying NAV, or put it another way, where are the stocks compared to the underlying value of the buildings themselves? And that changes from time to time. We've had periods where REITs have traded at significant premiums to NAV. Lately, it's been more significant discounts to NAV, and that's for one reason or another. It started out with interest rates hike in 2022, which caused the REIT sector to come down. More recently, tariff trouble and what the impact that could be on certain subsectors of the REITs have caused it to trade at a bit of a discount. And just, I'd say overall, some negativity from investors. REITs have underperformed the broader market for the last few years. So that has discouraged some investors.
Now, REITs have underperformed, but I believe this ETF that you actively manage has not underperformed. It's outperformed the index. Talk to me about your approach and what you do to get that outperformance.
Yeah, it's had a great long-term track record. So the ETF, sort of in one form or another, has been around since 2004 and trading as an ETF since 2015 when it was converted from a closed-end fund. And since that time, we've actually managed to outperform the S&P Cap REIT Index across every time frame, basically from year to date to 5-year, 10-year since inception. So it's been a great long-term track record. I think part of that is, our active management approach. It's not just a passive ETF. We have a team of 3 very highly qualified investment professionals with tons of expertise in the REIT space that are managing the fund. We can get involved in non-index names, which definitely helps. And some of those are often the subject of takeovers. And also we can obviously change the weights around. So we're not just sort of hugging an index by any means. So I think that has helped out a lot. We're lucky at CGAM to have a broad team that covers everything from the macro level to interest rates to obviously very fundamental in-depth analysis. So I think we combine all of that into a track record that has proven to outperform.
There's a lot of exciting stuff happening right now. There's a lot of M&A, people looking to take advantage of these low valuations. What does that tell you?
Well, it tells us that REITs are trading cheaply compared to the private market. So just recently in the last sort of 2 months, we've had one M&A deal announced, which was InterRent REIT, getting taken out at a decent premium to where it was trading, a little bit of a discount to where our consensus NAV is. So, we think the deal will get done. Whether they sweeten the deal a little bit is still yet to be seen, but still not bad for overall REIT valuations, and it kind of propped up the whole space. And then just about a week ago, H&R REIT, which is a company that announced a strategic review sort of 5 years ago and have been trying to reposition their portfolio. They announced, I guess, a week ago Friday, they've actually been approached by a couple of counterparties about a deal, which, in a way surprised us because it's a diversified REIT. They have assets across various different subsectors of the market, from office to retail to industrial to apartments. So to us, it wasn't clear that there's one logical buyer, but it sounds like, there's a pretty decent chance. So that got that stock moving in the rest of the REIT space as well.
M&A is one thing. Then there's also interest rates, right? If interest rates are directionally moving lower, is that a tailwind?
Generally, there's certainly not a one-to-one relationship between interest rates and REIT movements. But the volatility certainly in the last couple of years where rates were generally going up, that didn't help valuation. So we think anything sort of positive on the way down will help. What we need more, truthfully, is just some stability and both in interest rates and just some confidence in the overall economy. And that will get further transactions going. That will give further clarity on pricing. So we think even rates don't have to go down much further, but they just have to kind of stabilize for the REIT space actually to work from here.
Lee, thank you so much for joining us.
My pleasure.
This is Lee Goldman joining us from CI Global Asset Management.